let's just start with your just immediate reaction to what Jay Powell said yesterday.
Well, first, as a retired dot, I agree with Rick Santelli, by the way. These are just guesstimates. And as we know, they forwarded their guesstimates as to when they might raise rates, et cetera. My reaction was no news. I mean, I thought this was fully to be expected. I thought Jay Powell was very honest and very frank on retirement in terms of how it's impacting the calculation of full employment and how you can get there. Also, very frank about the possibility they may be wrong on their inflation forecast. They'll see it. And if they are, they'll adjust. So I found nothing surprising, the adjustment of some of the words, but more importantly, the way he expressed himself in the press conference. I was surprised that there was any market reaction whatsoever. The thing that we know is this: we're moving in the direction of less monetary accommodation over time. And that's been confirmed now. There's no doubt about it. It's going to happen.
So Jay Powell has effectively said that he'd prefer to be late than early in terms of moving. Do you think he's made a mistake by not moving fast enough?
I think you have to be very, very gentle here, because we learned in 2013, if you express yourself in a way that indicates you're going to move forcefully quickly, you get a harsh reaction that can come back and bite you on the economy as well. As a market reaction bites you on the economy. So it's a delicate path. I argued against QE3 and the continued expansion of the balance sheet because, as I said then, it's like kudzu. It grows without control, and it can take over the system if you're not careful. So I think he knows that. We've gone much, much further in expanding the balance sheet. Punching through $8 trillion by the end of this year, and we'll just have to see how quickly they can cut it back without disrupting the economy, and having a market reaction becomes disruptive and undermines confidence.
Well, let me ask you about this question about what's transitory and what may be the new normal, because if, in fact, the Fed is going to take its foot off the accelerator, you do have this issue, which we've been talking all morning about, this potential new infrastructure plan, because you might have the accelerator pressed down on another side at the same time.
Yeah. This is the risk that they've run with the new reaction function that they've outlined. They wait till it's confirmed. It's not transitory. It won't last. And then they raise rates or tighten on the balance sheet. That's a reactive mode. The problem is, as I've said on the show many times, the risk is rather, it takes a while for an adjustment in monetary policy to impact the real economy. There's a lag. And if you wait until you see the whites of the eyes of non-transitory inflation and then you adjust, then you're going to have a 10 to 18-month lag for it to take grip on the economy. And therefore, expectations of inflation could get worse and not diminish during that time frame and become more gripping. So that's the risk that's being run. I pray that they're right. I hope that they're right. But that's the risk that they're running.
But we've heard from Jamie Dimon this week. We've heard from Paul Tudor Jones and others ahead of Jay Powell's comments that they believe inflation is here, it's real, and they're preparing for it.
Yeah, I see that in the corporate world as well. Not only boards I used to sit on PepsiCo and AT&T or Tenet Healthcare, which I sit on now, but all the CFOs and CEOs I talk to are quite worried about it. And here's the point. You can't just make an overnight adjustment to inflationary pressure. You have to adjust your CapEx, your supply lines, et cetera. It takes a while to work through the system. Most of the corporate CFOs and CEOs I talk to are expecting this to continue on through next year. And that's the question. How transitory? What's the period of being transitory? But, you know, I think one thing to remember is this. Jay Powell, like any other modern Fed chair, does not want to go down in the record books as being an Arthur Burns. And I think he is very sensitive to the fact that there's a risk that the inflation could get out of control. There is a risk that the model they have right now may not be correct. And as soon as they determine, or he and the committee determines, that that risk is real, they'll adjust accordingly.
Shepard Smith here. Thanks for watching CNBC on YouTube.